Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table. Welcome back. You're listening to Money on Tap. My name's Seth Cressman.
And I'm Ben Brayshaw.
We are glad to have you aboard with us today. If you are a first-time listener, it's always our joy, our pleasure to welcome you to Money on Tap. We're going to have a lot of fun today, and our main topic we're going to be bringing to the table are 7 retirement tips for a turbulent market. That's what we're in today. It's important, it is vital, it is necessary for you as an investor to make sure you're on track. We've had so many conversations lately with you about this, and as you call in, as you email in, as we're going through reviews with you, just trying to make sure you're okay, you're doing the right thing, okay? That's what we're here for, and we're going to have fun with that today.
I'm excited about the show today, Seth. I mean, there's so much going on. The market's down 18, it's up 100, it's up 800, it's all over the place, and we've got lots of movement, and we got people with questions, and I think that's one of the things that we're going to kind of step on here a little bit and try to see if we can give some clarity to the world, and just honestly give you some other things to think about as well as versus focusing on just the market, which is good. I think it's going to be a good show.
I agree. Before we get too far down the road, we always want to make sure that you have access to us, and you can reach us at 855-226-8551 or info@yourmoneyontap.com. And I also want to thank you for all of the people that have been reaching out to us. We've been doing a lot of reviews lately with people, making sure that they understand that where they're at in their planning. Are they on track? How can they change? Even sometimes just your mindset is what needs to get reset in this place that we're at today. But a lot of the time there are investments under the hood that are really not serving your better interest. And so we do a lot of that review lately, and we want to thank you.
Well, before we get any further into this show, Seth, I think it's time for Money in the News.
Look out, Wall Street Journal telling us that with payments on pause, watch out, your credit score could be taking a dive. And lenders are supposed to give consumers a break on some of the monthly bills amid the coronavirus pandemic. But there's some nuances to this here, and some truth and some caution if you're in one of these categories that you need to be paying attention to.
Yeah, this article is really interesting and something that I would really take some caution around. It's great that different creditors and the government has gotten together and that they've worked out the ability to push off your payments. The thing is that credit reporting agencies are sometimes getting some misleading information. One thing that this article talks about specifically is that some college loans that were issued when payments were asked to be requested to halt, they actually put that they were not in good standing. It wasn't that they actually did that. They just said they were in deferment. Now, deferment doesn't sound bad, but actually in the credit world, it is still a negative, connotation of, where are your finances? So if you're in good standing, that means you're making your payments and everything's okay in the mind of a credit score agency. But when you put you're in deferment, that potentially leads to some sort of question mark of, is there a financial problem? Or are you not making enough money to make that payment? So that deferment issue, that has been corrected by a number of these college loan areas. But the problem is that there's a lot of mortgage lenders out there, and you might get a 12-month, deferment, but it's supposed to be reported on time. But honestly, they don't have to do that after a few months. I mean, there's some sort of stipulation in there that gives them the leniency to decide when you're no longer in deferment and you're kind of in arrears. So you have to really check it. And I thought it was interesting. The article talks about, Experian and TransUnion and all the different companies, because they're reporting to all of them. And so if you do have a mistaken report, it's probably on all three, and it can really affect your credit score. Because, I mean, bankruptcies can be on there for, over 7 years or something like that. I mean, there's some long period of time. And that can be, this type of thing, if it is on there and you're not even aware of it, and it really hasn't affected you because you haven't bought a new house, you haven't done this, you haven't done that in the last 3 or 4 months, well, couple of years down the road, you decide to do something, you might have a negative piece. So this article is really insightful to check on the correct reporting piece of this, Seth. I think this is a really good, listener beware what's going on.
Yeah, the other part of this is that interest accrual is still happening in the background. And if you're looking at a debt ratio, which is part of what the credit reporting agencies are looking at, meaning if you have $50,000 of available credit out there, and if you're somewhere around $25,000 of debt on that 50 total, they start to report more negatively towards your credit. And if you're in a situation where I've got bigger fish to fry at the moment, we get it. We just want people to be aware that if they have this idea in mind that everything's going to be just perfectly fine, nobody's going to say, the reporting's not going to reflect negatively because we're in this pandemic. That's not the case. There are some other pieces out there to pay attention to, you guys.
Yeah, this is important, folks. The same thing is that there's so much going on around everything financially. Like, we talked sarcastically a little bit about the volatility.
Did we talk sarcastically?
We did.
I don't know if we've ever talked sarcastically on this show. Just a little sarcasm.
Yeah, right. There you go. So, we talked about the market. It's all over the place. Down 1,800, up 800, some recovery, some not. We don't know where it's going. Everyone's wondering, man, if there's ever been an argument for active investors versus passive investors, today's the day. But what about things outside the market? I mean, I think that's the next question that our listeners have is, hey guys, we talk about the market a lot. We talk about investments. We talk about all different types of things. Well, there's an article that we found by Matt Becker, are CDs and savings accounts becoming viable investments again? And this is kind of an interesting conversation because we're hearing about the rates going down and so forth. And there's a lot of different moving pieces. I think this article really lends to a really good conversation around the comparison between bond fund returns and CD returns and kind of what's going on in that space. And he starts off the article just really talking about the concept of, having your safe money. Something that we chat about is having safe money and having your kind of risk on money, the money that you're looking for long term. Yeah. But he actually goes into the point of where is the market going? Are we going into a recession? Are we discussing, long-term depression here? I mean, there's some real big unknowns that we don't have out there. And he's saying in his article basically that, not only could this be your emergency fund money, but this could be the best rate you see for a long time. I mean, you hear about the airlines and the cruise lines and people are buying into those things and the market's going crazy up and down. I mean, these things are highly volatile, right? And you're hearing about people who are making money, people who are losing money. Warren Buffett's out of the airlines now. I don't know, whatever the story is. But the retired investor, that's not where they're going, right? That's not where you guys are investing when people listening to us today. But are these bank rates that are, he notes a number between 1.25% and 1.5% from various online accounts. Is a 1.5% or 1.25% return, Seth, what it's going to be for the next 5 or 10 years? Is that going to be the best return?
When it comes to a savings account or a CD, or the comparison there is the bond funds that he uses. What I like about the article is that he asks the question, what is the primary purpose of these accounts? When you take a look at this, what's your goal here? I mean, are we looking at a retirement fund, and that's how we're trying to fund our retirement? And some people, that's where they need to be as far as what kind of risk on approach they have, because they just can't take the market volatility. But for the most part, these are highly liquid accounts. These are the accounts that people use for the emergency funds. I need to buy a car fund, or I have a medical emergency over here that I need to try to fund. And so keeping liquidity and having cash on hand for that purpose, yeah, we're all for that. Bigger picture, we've come across so many people that have had the tendency to save too safe. Does that make sense for what it is their goals are?
Yeah, I mean, you can be too safe, right? I mean, that's the point. I mean, we wouldn't be talking and we wouldn't be investing in the market if we thought that it was ultimately a long-term loser. But when he starts getting into comparing, I mean, he does reference one Vanguard bond market index fund, and it's producing a yield near 1.175% roughly. They talk about these yields. He's kind of a little out of the loop here on the market side of this when he starts talking about these yields. I think the reason he's out of the loop is because you can compare one bond fund to another, and one yields 3%, one yields 1%, and honestly, it could be meaningless based on really what they're going to do long term with these yields. And honestly, some are more growth focused versus yield focused, and you don't know what the underlying stocks are that and how they're going to handle their yields. I mean, we were potentially looking at a yield decline over the next 5 to 10 years as companies try to get out of their debt that they've borrowed on, and so that's something to be aware of. And I honestly think that even though he's trying to make the comparison to a bond fund, I think he's really missing the idea that, for maybe 25 or 50 basis points or a quarter or a 0.5% of return, the solidness of a CD or savings account, I mean, I honestly don't know that I would take the bond fund yield as a comparable, as equivalent or worth the risk for an extra quarter or 0.5 point.
I would agree with you on that. Like based off of the recent volatility, especially, or the potential volatility in bonds, there is more risk there than people realize.
Oh yeah, way more. And honestly, we don't even know about the defaults coming. I mean, there's going to be so many companies that go under. I was talking to somebody the other day, and I was explaining kind of the concept of, this gentleman called me, and he was like, I'm really concerned about the market. I think recession's coming. I think we should, X, Y, Z. And I told him a little bit about what we were doing with our portfolios and how we had gone to, anywhere from 5 to 12% in cash, depending on some of our managed portfolios a little bit ago. And, literally days before the large drop we saw. And, we were just trying to take some profits, just a little bit. I mean, there's no reason to be greedy. And, he's like, oh, that's interesting. He's like, but I'm hearing, hair salons are going out of business and this, that. And, I mean, he's talking about like the mom and pop shops of America. And I can totally agree with that. And I turned to him and said, we're not buying hair salons. We're not, that's not.
You're not?
Yeah, that's not where the investments are. So, it's hard to distinguish, how investments, are allocated and where they go and what the point is of them. But when it comes to your safe money, I really think this guy's spot on. I think there's some interest rates here. I mean, I had a couple clients who we had proposed some annuity investments to them, and they chose. This was months and months ago. They chose to go to a fixed annuity, which rates were much higher. Things were doing really well, and I was like, okay, well, yeah, you want to take a conservative approach? We can do that. That's fine. And it was a really strong rate. I probably wouldn't even want to say it on the air here. Yeah, I'm not going to say it on the air here because it was so high. And honestly, they took that. They don't offer that. Rate's not offered anymore. And but they took it. I'm like, wow, that really worked out well for them. And really, the conversation wasn't about the market. It wasn't about the rates. It was really about safe money and just having some sort of, fixed return in a portion of their money. And I said, hey, that's responsible. I totally appreciate that. I presented them the options. They chose, and off they went. And they're happy with that. So there's a lot of opportunity inside just being conservative in some of your portfolio, even if it's not the money you might, need, tomorrow.
On a temporary basis is where you're coming from there, right?
Yeah.
Temporary liquidity, looking for opportunities.
Exactly.
Yeah. Speaking of looking for opportunities and buying hair salons, we've got an article here by Brett Arends that it's an opinion piece. It says, yikes, the private equity crowd wants your 401k money. And gosh, I stumbled across this, or no, you stumbled across this, didn't you?
Well, this article I stumbled across, yeah, but we had chatted about it the other day.
It tripped both of us up, I think, is the point.
Well, I mean, I had heard about it, and that's when you and I chatted about it, and I found this article.
Yeah.
It just popped up. And I really didn't care about the article because the article was kind of crummy. It was short. It didn't really get into a lot.
Sorry, Brett.
Yeah, sorry, Brett. That's our opinion. And but I will tell you that I've heard a lot about this, and this has become an issue. And we've worked with a lot of people who have had private equity buyouts with companies that they've worked for or worked with still. And it's just kind of interesting because there's been a lot of push by people who are in their 401ks, who are executives or higher rolling people, to want to invest in things that are more aggressive. But the private equity space has been something that's really been for accredited investors, which are people who are worth over $1 million or, make $250,000 a year. And there's all these different requirements that you have to be invested in this. And what they're doing is they're creating a fund for private equity investments to create diversity and to reduce risk is their hope. And but this is a really risky space. I mean, I'm actually blown away that they've opened up private equity into the 401k space. But this has come on the push that people want more diversity, they want more opportunity, and they're willing to take risk. And the private equity space has been profitable many, many times, but the losers are big losers, and that's a scary part.
It is, and I when I take a look at that, I see two sides of the coin. It's great for private equity because having an inflow of capital really allows them what they're looking for, which is the money on board to do what they do. But it's such a high risk space, and there's so many other newer investments out there of the last 5-6 years. I would say crypto would be one of those that we've could be considered in this space, as well as potential returns and diversification for their clients. But the problem that I have with this is people's retirement, right?
This is crazy. I mean, you talk about all these different investments you're mentioning, Seth. I mean, it's crazy high risk. And to be dragging
the average
this into
Joe can't understand or take this on board or take this kind of risk with their money, would you say?
I would totally agree. I don't think that this is a really prudent move for the 401k space. I actually think I would, highly discourage you if you're even nearing, 10, 20 years of retiring. Buyer beware big time. I mean, you've got to have 30, 40 years. If you're new into the 401k space and you're just starting to put your first dollars in, well, maybe. But even then, I mean, what is private equity? So, I said that's probably half of what our listeners are saying. Well, what is private equity? I hear about this private equity, venture capital, all of that.
Well, clearly, before we go into the what is, we have to just say some disclosure here and say there is no way that we are recommending this for anybody listening today. Please don't ever take what we're saying right now as a recommendation. We're just trying to understand where they're going with this. Go ahead.
But this is why. I mean, this is why we're saying that, because private equity is investing in private non-traded companies where they think that they can take a position in a company that would be a majority usually, that they can then take over and redirect how well they should run and focus on finding profits, exploiting the company for either, dismantling and selling off pieces for more money. I mean, there's so many different things that they do. But then you get into the venture capital space, and the venture capital space is it's a version of private equity where, they're literally just, working with startups. Now, you could be exposed to a number of these types of scenarios inside an allocation like that. So, for our listeners who have a 401k, who are going to start seeing some of these potential allocations in there, I would probably encourage you to not just jump in if that's your first inclination. I would actually get on the phone with a 401k provider, and I would learn a little bit about the allocations of that private equity, what they're doing, the risk associated with it, and then try to get some advice on either if you're going to allocate or want to after that, how much you should do. What type of small piece maybe that might play for you. But there's just enough opportunity in the market, and there's enough volatility in the market to endure that adding private equity to the mix is maybe more than concerning.
Yeah, I think of the type of suitability, the type of person that this is a suitable investment for, and ideally they should have money outside of their 401k that they've saved and they have available for opportunities to be investing like this. And that's traditionally how these investments have worked. So to bring it into the 401k space, down the road, it just sounds like palms greased and lawsuits waiting to happen.
Oh, I know, because the thing is, that's a great point. That's a great point. If you're listening now, because those target date funds, there's so many lawsuits over those stupid target date funds because they either think that the manager had too much in bonds or too little in bonds because they're designed to try to target when you're going to retire. And what they're doing is they're slowly, year after year, blending how much more conservative they're getting each year as you approach retirement. But the problem is anytime the market crashes, there's some lawsuit about how it wasn't, it was too conservative. Or when the market's rising, they're saying, well, why do you have so much money in bonds? It's like there's all this back and forth. And I think you're right, Seth, this is going to be a massive legal battle. They've had less lawsuits from my understanding of the numbers when they never had target date funds. They never had any of these kind of crazy allocation things that they love charging fees for, extra fees because of the extra management, than just going out and buying simple, either ETF or mutual fund allocations that are just well balanced and diversified and looking at lower cost. Honestly, when you start getting into higher costs, you really have to see if you're finding value. And that's one of the problems.
You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Before we go and come back, we're going to let you know, first of all, we're going to be talking about 7 retirement tips for you in a turbulent market. These are some important things to really, center ourselves and focus ourselves and make sure that we're on track. And also, I just want to thank you for listening today. It's a pleasure to have you on board with us, and we've had a lot of fun with our listeners lately, having conversations with them about their 401ks and about their planning, and just helping to make sure they're doing the right thing for themselves now. So thank you for you who have reached out to us lately. That's been a lot of fun for us too. We'll be right back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com.
Hi, my name is Ben Brayshaw, one of the co-hosts of Money on Tap. If you have questions when it comes to your retirement and are looking for a personalized solution, contact us at Brayshaw Financial Group. In today's volatile stock market, we can help you plan to find your successful retirement solution. Am I saving enough? Am I saving into the right places? Do my investments match my appetite for risk? Do I have a tax strategy that is going to help me keep more of what I earn? How can I maximize my Social Security income? If you are like most people, you are getting closer and closer to your retirement and may be wondering if you're taking the right steps. If you're in retirement, you may be wondering, am I maximizing my income while preserving my estate and caring for my family? We talk about all things financial in what we call three-dimensional investing, putting a plan around your financial future. If you feel that now is the time to start getting the answers to some of these questions for your own situation, give us a call at Brayshaw Financial Group at 855-226-8551. Headquartered in Bedford, New Hampshire, we have offices throughout New England and across the country. We would love the opportunity to show you how we can help. There's absolutely no cost or obligation just to meet with us, and we welcome you to our office. Call us at 855-226-8551.
Now back to Money on Tap with Ben and Seth.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Today we are, having fun, right? That's what the show always is about, is having fun, talking about personal finances. And as promised, we are going to be giving you 7 retirement tips for a turbulent marketplace. There's a lot going on right now. I mean, it just depends at between when we're actually doing this show and when you're picking it up off the shelf and listening to it. Holy cow. I thought tech was moving exponentially.
Seriously. The turbulent market is something that has become kind of a new normal. I mean, of all the new normals that we're kind of stuck with, I think right now, new normal is it's up, it's down, and it's going to be big, and it's going to be bad, it's going to be good. You never know what's going to happen. But, I mean, some of these swings, 1,800 points, all this stuff you're hearing, up 800, pull back during the day. There's all sorts of stuff going on, and that is really, really scary for a lot of people. And it's something that is, kind of our number one. It's just part of life. Now, before, people would get nervous when the market moved a few hundred points in a day. 300-400 points was a big deal. Then 500 or 600 points was a big deal. As the market gets bigger, as the Dow, for instance, gets to be a larger number, the percentage point swing sometimes is just as big as it was before, but it's just because it's a bigger number. It's more dollars moving. So things move in percentages, not just necessarily dollars, and that's something to be aware of. And kind of dealing with kind of the crash mentality and everyone kind of getting ready for that, pullback, that big pullback, like how far back are we going to go, maybe a second time? There's some truth to that concern. There's some truth to, what does the new marketplace look like? How many stores are going to be vacant? How many buildings are not going to be paying or tenants not going to be paying rent? Those are real issues that I think we're going to be facing and weeding out as the world moves forward. But I think these kind of tragedies and these unforeseen things, these are where we have overcome as a country over and over and over again, which has made us who we are today. And we are going to kind of conquer this again. And I think, those stores will be filled again, and there is going to be a recovery period. But the market itself is going to move inside of those domains. And then there's going to be stocks and investments that move outside of those domains who are, kind of the new opportunity. I mean, I'm looking at the NASDAQ hitting an all-time new high. That investment range is crazy. But that wouldn't have happened, I don't think, if we didn't have a shut-in where every technology company the demand for their need to help run the businesses that existed during this time would have been called on to fulfill the void. Look at Zoom. Zoom was a kind of a known software. Now it's a common household name for every child, practically, of every school, because Zoom said, hey, listen, we're going to help the schools. I mean, they made themselves a nationally known name now. And that's the new ebb and flow.
You can reach us at 855-226-8551 or info@yourmoneyontap.com. And the new normal. It's an interesting conversation.
I don't like the term. Who doesn't like the term out there? I mean, does anyone want to talk about new normal? Because a lot of people like their old normal.
Yeah, sometimes it makes me want to run and hide, I guess.
I know. Like, what does that look like? Well, the market has always been an uncalculated beast that goes up and down on us, right? I mean, I think beast is the best word because it is just something that changes the world for which we live. Number two, the kind of the next step or one of the things that and you hear all advisors tell you, don't just pull your money out. Don't just run for it. It's usually, the volatility is hard to swallow, but usually at the end of the day, if you really believe in what you own and you think long-term it's the hold, you do that. Now, I mentioned earlier that we had taken some profits a while back right before the big drop. That's just kind of what money managers do. That's what we do is we look for opportunity. We collect a little bit of the profits from that, and then we look for another opportunity. And that's not a bad piece to have in your portfolio, but what we found is that, and John Hancock did a study on this years ago, that it's like 80% of people never reallocate or rebalance their 401k. It's just some crazy high number. That's because a lot of people just don't know what to move to. They don't know what the next investment should be, and that's because they're not trained to do that, and that's okay. So don't pull out just because the market's going down, because usually, for instance, in some days when the market drops 1,800 points and you sell that day and the next day it's way back up and you're like, oh gosh, I just lost a ton of money for no reason. Those are hard days to swallow.
Yeah, I think the research is pretty clear around individual investors versus the market and the underperformance there. One of the primary reasons for that, and I think it's by around 4%, roughly 4%, that an individual investor will underperform the historical data from the S&P 500. And that is a number that is primarily because when dips in the market occur, fear takes over, investors pull their money out, and they think they're going to go ahead and they're going to time this and they're going to get back in before everything goes north. And then, what they wind up doing is holding on to it until most of the market gains have happened, and then they feel comfortable, and then they get back into the market. Well, had they just stayed invested, with those dollars that they had purposed originally to put into that market at whatever risk allocation they're in, they would have done far better. And so part of the planning, part of what we talk about here is having the mindset and the understanding around what kind of volatility to expect, what is going to happen potentially, and most likely based off of the numbers that we have behind us, this is going to happen in the market. And we want you to set those parts of what you're doing 10 months ago and today, continue to have that mindset currently around those investments that you made that 10 months ago, a year ago, 2 years ago.
That's a good point, Seth. And I was, a lot of people don't realize I heard this report one time, and I can't remember which money manager it was at Fidelity, but and which fund it was. But there was the return of the fund was phenomenal. It was like some ridiculously high average, but the average investor was like making less than 2 or 3%. So the guy was doing the manager was doing well over 10%, I think, on average, like historically. But what was happening was the average investor was doing like under 3 or 4% because they kept buying and selling out of his portfolio out of fear.
I remember that.
You remember that? Yeah. And so,
I do. Yeah.
And so it was like he was just saying to himself, he's like, I don't know what to, like, I mean, I wish people would just trust me. Like, it's okay. We're going to do this fine. But his track record was phenomenal. But people, like, the market would drop all the way down and people would sell everything. Market would go back up and they say, oh, I got to buy back in. They endured the entire loss. The average Joe is giving all the big money managers their money because they sell. That's what's happening, and if people don't realize that, you're so fearful you're going to lose everything. You don't get in the market if you think you're going to lose everything. If you can't buy something and hold it, and you can't figure out how to slowly get out of something, if you slowly get in it, then you should slowly get out of it. And it needs to be strategic, and that's where, like, this time period is where active versus passive. We talked about that on a number of shows. People want to just buy the market and hold. And I'm totally for that. That's passive investing and so forth. But right now, there's not a listener that we probably have here that's qualified to do their own active investing, which is sell and buy and sell and buy and sell and buy. And just because the market's doing this, the market is a beast, and you're never going to control it. It's nothing anyone controls. But pulling out because the market dropped on you is just giving away money to somebody else.
Good point. You can reach us at 855-226-8551 or info@yourmoneyontap.com. You're listening to Money on Tap, and we are talking about 7 ways that you, right now, can engage around your retirement. And these are 7 retirement tips to remember during market volatility, basically. That's what we're talking about right now. We've gone through 3. We've gone through 2. Number 3 is keep up regular contributions. This is a part of what you're doing, which you should be doing all the time. If you are planning to retire, regular contributions is a part of the strategy that you should already have baked into the numbers. If you're in a 401k or some kind of workplace retirement plan, then it's pretty much happening every pay period for you. That's what's most common, is a part of your check is going into investments, and taking a look at those investments and making sure that you aren't necessarily just automatically allocated into the target date fund. Okay. And that those investments are serving your purposes. That's a part of it. But having that ongoing contribution is going to help you take advantage of the volatility.
Well, just buying into the market, making those regular contributions for those of you that, are still working, despite the stay-at-home order. And a lot of states are starting to open up really well now. I think Pennsylvania just removed all regulations on the stay-at-home. So, but if you were making contributions, just keep making them, because when the market goes down, you're just buying those shares, those allocations at a much lower value. And I've had conversations with people over the last few months saying, hey, market's way down. It doesn't matter whether it's at 20,000 or 18,000 or 25,000. It's below what it was before, and you're just buying things cheaper. They're on sale. And as the market rises, they're less on sale. I mean, it's not the 50% off deal that you used to have, but it's still 20 or 10 or 5. And, those regular contributions get a portion of that sale price. And you got to remember that. And you got to look at it that way, not say, oh, I don't want to put any money in the market now. It's way too low. No, you want to buy low. You want to buy lower. So, and that's a hard thing for a lot of people to do.
Number 4, resist the urge to check on investments daily. Nobody can predict when falling market's going to start to rise again. Okay. Go back March 23rd. Nobody knew that the market was going to do what it did March 24th onward. And right now we're not predicting that the market is going to do anything at this moment, but the ultimate here is that we do know that over time, the market has proven that it's going to go up.
Yeah. That is one of the things. People get married to their investments. They're constantly looking at it. Honestly, that's why, that John Hancock statement I made earlier about, how many people reallocate or reinvest their 401k. For the most part, the people who just keep contributing and don't look at it actually seem to do the best anyways. But
forget about it.
It's because usually when people do get engaged, they're not qualified to engage it. And it's not meant to be, a knock on most people or anything like that. It's just meant to be that it's just really hard to understand all the moving pieces and where you should go and how you should do it. I mean, even professionals get it wrong, right? And so to think you just...
But typically the professional is quick to correct and accept where they have been wrong, right?
Yeah, no, that's great. That's a good point.
Yeah, instead of getting married to the idea that I'm going to be right no matter what I have to be right, accept that you're wrong and wrong often, and correct those and move forward and make those other decisions that are going to help you out in the long run.
Exactly, Seth. That's a great point. That's a great point. The other piece of this is number 5 is diversify your portfolio. Now, this is an interesting conversation because we talk about, and Seth and I will talk about this from time to time, is these quilt charts and different things. And what that is that's just a reference to figure out, what's going to perform the best in any one year, right? So you talk about whether it's large cap or small cap or mid cap or bonds or, value or growth, all these different domains. A diversified portfolio will take and engage in all of those to try to just mitigate the pros and cons of the market every year. And it's funny, when I look at some of these quilt charts, we'll say one year the small cap was the best, and then the next year the large cap value was the best, and then the next year the bond value was the best.
Well, 2019, how many times did we reference cash was the best?
Yeah, exactly. 2018. Yeah,
cash. 2018, the rolling 12 previous, right?
Yeah, the cash was the best performing asset class out of the entire marketplace, but everyone thought the market was up. But it had lost all its money in the last month. So when you look at that, when you look at those charts, and there's usually 10 sectors, right in the middle, you should see that diversified portfolio. It should be balanced in the middle. And that diversified portfolio is trying to create exposure into all different asset classes in a way that mitigates both downturn. You should not be performing at the top, and you should not be performing at the bottom. Now, what's funny about that for us on the advisor side is that everyone says, well, you didn't perform as good as that class, or you didn't perform as good as that class, because they only hear about the very best performers. And for us, we're really trying to mitigate long-term losses, because those long-term losses, if you're at the bottom could be as deep as you lost everything.
Yeah, I would say it's interesting. Sometimes people get enough knowledge to hurt themselves. And everybody's done that. Everybody's been in that circumstance. And the person that comes to the table, well, large cap has overperformed the rest of the segments for the last 20 years at X rate versus another segment or another diversified portfolio. But it fails to account for really the purpose of diversification around and throughout a portfolio, and how driving income becomes another part of the story, and how protecting an asset becomes another part of the story. It's just purely and it's a relationship that most people's brains function well at, and we understand. And that's what we are looking for, is understanding around what it is that we're doing today. So number 6 is evaluate your risk tolerance. How many shows do we even have on risk tolerance now, Ben? Like maybe 10?
A lot, a lot.
Yeah. Oh, hey, we need to take a quick break. You can reach us at 855-226-8551 or info@yourmoneyontap.com. You're listening to Money on Tap. We're talking about 7 ways you need to be focusing yourself right now in spite of the market volatility going on. And it's a lot of fun to have you on board on Money on Tap. You can reach us at 855-226-8551. Hi, my name is Seth Crustman, partner with Brayshaw Financial Group and one of the co-hosts of Money on Tap. One of the biggest concerns and largest expenses people face today is taxes. Without thoughtful planning, taxes can destroy future retirement dollars, eliminating the possibility of a timely retirement or dreams of what you want retirement to look like. If you're like most people, you're getting closer and closer to retirement, and you may be wondering if you're taking the right steps. Will my income be enough? Will rising taxes force me to give up my dreams? How does inflation factor into all of this? These are real concerns, and you're not alone. Putting a plan around your financial future is what we do. If you have questions when it comes to your financial security, and if you're looking for a personalized solution, contact us at Brayshaw Financial Group, 855-226-8551. It's time for you to start getting answers to your questions. Headquartered in Bedford, New Hampshire, Brayshaw Financial has offices across the country. We'd love the opportunity to show you how we can help. There's absolutely no cost or obligation to meet with us. Call us at 855-226-8551. 855-226-8551.
Now back to Money on Tap with Ben and Seth.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. It has been so much fun over, the last year, I'd say, but the last several months, especially, just some of the focused conversations we're having around the topic today, which is
7 ways to address the turbulence of the market, Seth.
Thank you. I appreciate you finishing my sentence there.
Seth, we were leaving off. We had to take a quick break here, but we were talking about number 6, which is evaluate your risk tolerance. And you had mentioned, we talk about this a lot. Risk tolerance is something that is literally at the core. Before you even make an investment, it is at the core of your decision making. To understand your risk tolerance and then evaluate investments that fit in that realm is really how it works. Not to say, hey, these are all the investments I worked on. What's my risk tolerance? So if 5 months ago you had bought airline stocks, you would have lost, 80, 90% of your money at the low, some ridiculous amount.
That's a lot.
Yeah. Look at what happened to Warren Buffett. He sold out of everything. Those types
at the bottom.
Yeah. And so even a guy like Warren Buffett can make a major, major blunder.
You hear that, Warren? We're telling you right now. Big mistake, buddy.
That's okay. We're happy he lost it. It went back to some people that needed it. That's hard to quantify, especially if you're the average Joe. You're just trying to make a living. You're trying to manage your 401k. You're not really sure what's going on. Some of you might be, hey, I'm trying to manage my 401k, but I don't have a job anymore. And if you're listening to the show and that's your situation, give us a call. We can talk to you. We can talk to you whether you have a job or don't have a job. You want to talk about your 401k. Those are open opportunities for us to have a conversation with you and see if we can be of help. We're there for you. You can reach us at 855-226-8551. But the risk tolerance piece is something that if you're not really focused on that, it can burn you because you end up buying something that's just so far either out of the risk tolerance that you're either prepared for or is so far out of an unbalanced risk. Like I've had people where they've overbalanced in one sector so far that the risk that they're taking on that sector, even though the sector is not a really super high risk, the fact that they're outweighed there is really a problem.
See that so often in a 401k. For whatever reason, that 401k is offering 4 different mid-cap funds. And, they're looking at the performance of mid-cap the last year and they're thinking, oh my gosh, I got to get on board with that. And they get really super heavy in that sector. And then next year, the mid-cap just tanks. And
happens all the time, right? Listeners, everyone knows what we're talking about. It's kind of like the racetrack theory. You always hear about, the horse everyone made a ton of money on. They won't tell you about the $100,000 they lost there over the last 5 years, know? So
Right. Hey, on that risk note, if you go to BrayshawFinancial.com, that's our website, Brayshaw Financial, BRAYSHAW, financial.com. On the right side, you'll see resources, and there's a free risk analysis tool there for you. So you can go ahead and upload your portfolio and see where is your risk at. You want to have that. It's free. It's for you. Grab it. And last but not least here today, Ben, we've already kind of talked about this, right?
Yeah, this is great because this ties right back to our market articles and completely unplanned, actually. But it just maybe it was subconsciously planned, but it was not consciously planned. But maintain funds and liquid assets. We talked about the bank CDs. We talked about savings. We talked about return issues and opportunity inside that. There's a lot there. And I think when you really break down maintaining liquid funds, you can get liquid funds in your 401k. If that is your only investment and that's really where your assets are, then having some of that is a good opportunity. What I would say is that if you're really concerned about the market or you're really going to dabble in moving and manipulating your 401k, every time you go up a little bit, I would just add a little bit to cash. And every time the market goes down 5 or 10%, maybe take a little bit of that cash out and put it back in the market. And just a little bit, just to manipulate enough to make sure, because a lot of people don't want to take their money out. But if you have like some sort of rhythmic scenario where you're saying, hey, listen, I really don't want to take it out when the market drops. But when the market drops, to have a lot of cash on hand to be able to put that in, it's going to make you feel good. And you're going to know, hey, listen, I'm taking advantage of that. I did some dollar cost averaging in and out. Again, it's not meant to be something that you utilize to try to really strategically manipulate the market. It's just being disciplined about taking some gains when the market performs. When the market drops and you're taking gains because you're giving in, that's really not the right time. Because probably a lot of people do, but they end up losing a lot, and then the market kind of has these rebound days. Maintaining funds and liquid assets also gives you the ability to really just say, hey, listen, if I'm going to put 5 or 10% into a money market fund in my 401k, when the market has a catastrophic drop like it has, you say, hey, every time there's a catastrophic drop, I'm putting the money in. And maybe that catastrophic drop is when we hit a bear market, it's down 20%. That's the story when you do it. You say, hey, listen, when it hits that negative 20% or something, Seth, you just say, hey, that's what I'm going in. I just know I got a discount days.
Here's the hard part about that, folks. It takes some discipline. It takes some planning and strategy, and you got to stick with it. You're going to look at the market going up 10 whatever percent that year, and you're going to think, oh, I should have had that money in there. I should have done this. And hindsight is already giving you a push over the edge to go ahead and put it in. And then that's when that market pulls back. And then you say, man, if I would have had that in cash, I could have come into the market here. So have that strategy already in place and remind have the conversation that you need to have to stay focused and stay in the game. Okay. Stay at the table. Right. And I love what you're talking about as far as that market pullback in that bear market scenario, because why would you buy? Your brain's telling you don't buy now. Market's down. It's going down, and it's probably going to go down tomorrow more. But here's the thing is do you think the market will actually come back to what it was prior to dropping 20-30%?
Yeah, I mean, you have to believe that the market's going to come back if that's the scenario. But if the market drops 10% on you, or 15%, maybe make up your own story. It drops down a certain point. Let's say you have 5 or 10% in cash. Maybe you take 20% of that 5% and stick it in. And the market drops to 20%. You put another 5, 20% of that 5%. And then market drops down, 25%. Maybe you take in like 30%, and the market drops down 30%, maybe you're putting the rest of it in, or you're putting the next half of that in, or whatever. Mm-hmm. I mean, market goes down 40%, at that point in time, either money's worthless, or we're really we got to rebound at that point. I mean, there's that 40-50% drop range. That's super great recession. that's when you're saying, hey, that's amplification opportunity. If you're long the market, if you believe it's going to recover, if all of these ifs. But this is something that people are looking for, and I just think that people they're always all in. They're always all in, and they never know how to get out. And I think if you just say, hey, listen, market starts recovering, the market recovers 10 or 15%, I take 1 or 2% out. And then you say, how much cash do you want? Do you want 3%, 5%, 10%? What do you want at the peak? Because the peak is when you want more cash, right? Because you're waiting for the trough to happen again. So, I mean, those are things to think, consider. I wouldn't make any of those decisions. I wouldn't do any of that stuff without real advice, real help, and so forth. And that's not a recommendation on my part other than just being cautious, okay, and knowing what you're doing.
Folks, you've been listening to Money on Tap. We've just given you 7 retirement tips to remember during market volatility, okay? It's a tough thing to stay engaged and stay on track during these times. Thanks for joining us today. You've been listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Also, we're in a podcast. You can find us at any of the podcast venues out there. We appreciate the likes and the listens. We're also at Facebook at /3D Investing and Twitter at BFG_LLC. We appreciate you joining us here today, and we hope you make it a great day and a great life. Thanks for joining us with Money on Tap.
There are a lot of pieces to helping our aging parents in the final chapters of their lives. On this Cliff Notes edition of Money on Tap, Seth and Ben look at the importance of addressing our parents' finances, something that needs to be handled with a certain amount of urgency.
Financial conversation can be one of those bridges. It just takes more time than maybe some of the others to really cross. So really, think about how they are engaging in their finances. Is it a checkbook? Are they online? Are they using credit cards? How many do they have? How they operate around their finances is even just a conversation possibly that can introduce this and help that conversation move forward.
Absolutely. And I think, the interesting story too, I had in that scenario, just an example, there was a health change, an event. People said, hey, we want to come in. We want you to meet with our son or daughter. And everything was, it was a little bit of heart concern there. Some kind of stuff had popped up and everyone was aware. Now things have kind of settled down and things are a little better, not perfect, but better. And they're like, we're going to try to do this stuff over the next 6 to 9 months. So what happened we want to meet with you next week, now turn into 9 months. And I'm talking to them. I'm like, listen, this is not an overnight decision. These are not overnight issues to address. They take months to address. So 9 months from now, if we sit down, it's not going to be like flicking a light switch from, off to on. There's a process and there's a lot of work behind that. And I said, you still want to move with urgency. And some of the stuff they want to do, they want to put into a trust, and it's complicated, and they want to, they want to protect some assets, and they need a clock to start. And I said, listen, if you're going to do that trust, you have a 5-year clock. This is what they needed to do. And I said, if you wait 9 months, now you have a 5-year, 9-month clock, but you still haven't even had any time to get with the attorney and write the trust and make sure that's correct. So now you got a 6-year clock. You need to get that clock moving as soon as possible. And trying to explain urgency around making these decisions is really important, because financials are usually the number one thing I find that people do not want to let go of. They do not want to hand that over to the kids. They don't want their kids telling them what they can spend or buy or do. They think that's all about what this is, and it's not.
Yeah, making sure that you're documenting what's going on there. I've seen a lot of people kind of create a worksheet or, just kind of like an inventory, really, of all the different things that are going on: Medicare, long-term care policies, all these different policies, life policies that can be
have a list. Have a list for who your accountant, your attorney, your CPA. Right.
All in one place, easy.
And what we do is we provide a listing. We provide online access. We provide, documentation for a complete list of assets depending on the person's scenario. But we've done that for attorneys, for accountants, for people's kids. We encourage people to bring their kids into our office. We want them for 2 reasons. One, we want them to know what their parents own, why they own it, okay, and what the purpose of it is. Because after after a plan's been put in place, having kids come in to evaluate a plan and figure out whether they think it's good, bad, or indifferent makes things much more messy than trying to understand why they went into this initially. And I really always encourage that, and I know Seth does too. So
thanks for joining us for this Cliff Notes edition of Money on Tap, with great tips from the pros in three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.